Welcome. This is part 2 of looking at insolvent partnerships in our coffee break briefings. First one was last month, and I'm going to cover these points today. Firstly, I'm going to give a quick recap on some of the points that we looked at last month. Then I'm going to look in a bit more detail about the process of unscrambling the bankrupt partners' estates. And then after that, there's a couple of case studies I would like to look at. The first one is what I'm calling the zombie partnership, and the second one is what I'm calling the untouchable partnership. And then after that, I'll be looking very, very quickly at partnership administrations and a couple of issues arising out of that. So these are the points that we covered last month, and I will just race over again very, very briefly. It's looking at a reminder of what a partnership is and how it's different from a company, looking at how to analyse the various estates within a partnership and what the options are for an insolvent partnership. So on with the first of those. The key thing about a partnership is to remember it's not a corporation, it's not a company. A partnership is simply the relationship that exists between people who come together to do business together and make a profit out of it. Doesn't matter whether they actually make a profit or not. If they're intending to make a profit, that is enough. And the existence of a partnership is a bit like a force of nature. If you come together to do business together, the chances are that you will form a partnership. And there were a couple of diagrams that I looked at that I'll put up again now that illustrate the difference between a company which does have legal personality and a partnership that doesn't. So this diagram here shows you a company, and the company is a self-contained legal person. In law, it is treated as a person. It's owned by the shareholders, but it's separate from them. As a person, the company is able to own its own property, and as a person, the company is able to transact with the outside world and make contracts with its customers and suppliers and enter into other legal commitments. The company, of course, as a legal person, doesn't actually exist, so it has to transact through its representatives, its agents, and they are the directors and the employees. And when they're acting as agents of the company, they can commit the company to obligations, but they themselves, as its agents, are not personally responsible for those obligations. It's the company on whose behalf they're transacting them that is responsible. Partnership, on the other hand, doesn't exist. It just describes the relationship between the partners. Here they are four individuals, A, B, C, and D. The partnership doesn't have legal personality. It can't itself own the partnership property. So here the partnership property is owned by two of the partners, C and D, who hold it on trust for the partnership as a whole. The partners, being individuals, being real people, are able to transact with the outside world, and they can therefore make legal commitments, contracts, and other types of obligations with customers and suppliers. And when a partner does so, they are committing all of the partners in the partnership to that obligation. And the partners may also delegate that authority to employees and other agents. And when those people make contracts on behalf of the partnership, they will be committing the partners individually to those obligations. The employees, as agents of the partners, are not themselves personally liable on those obligations. And we have here the compare and contrast slide that shows that a company, because it has legal personality, can own its own property, it can make contracts, it can sue and be sued on them, and the company continues in existence even if a significant shareholder or director leaves. Partnership is different because it doesn't have legal personality, so it can't own its own property, it can't make contracts or sue or be sued. It's the partners who have to do that as individuals. And because the partnership describes the relationship between people coming together to do business together, if one of them leaves that relationship, the partnership ends. So as a result of this, the partnership itself is a complicated mix of several estates because the partnership itself doesn't own property and the partnership itself doesn't have obligations. It's the partners as individuals who do that, and that all needs to be unscrambled in an insolvency. Final thing I looked at last month was the main options for an insolvent partnership. And the first one is bankruptcy, and there are many bankruptcy options, including debtors' petitions, which are still possible in a partnership. So it's not just the online filing with the official receiver that's possible for a member of a partnership who's insolvent. And also within option one, you've also got the ability to wind up the partnership estate itself, the joint estate, as an unregistered company and through a process which is compulsory liquidation. Option two is voluntary arrangements, which can be individual voluntary arrangements or partnership voluntary arrangements, which are rather like company voluntary arrangements, or it can be a combination of both procedures. Administration, which is in many ways very similar to the administration options that you have for a company. Option four I've got down there is one that doesn't exist, and that is a creditor's voluntary liquidation. There is no partnership CVL. What you might find as being the most appropriate way of dealing with it if you've got an insolvent partnership, and a CVL would be appropriate if it were a company, you might find that a partnership voluntary arrangement would actually allow the partners to wind up the partnership in a sensible and useful way, similar to a CVL. And just as you do not have a CVL for a partnership, you don't have an MVL for a partnership either. So if you've got a partnership that needs to be wound up through a solvent procedure, it's best done with the partners themselves, either following their partnership agreement or agreeing between themselves how it's going to be done. If they can't agree between themselves, it may take a court order to dissolve the partnership and to wind it up. And in some cases, you might even appoint a receiver or a receiver and manager to take over the administration of the partnership assets if the partners really are at loggerheads with each other. So that's what we covered last month, more or less. Let's move on now to this month's topics. And I want to move on now to the process of unscrambling the bankrupt partners' estates. So I'll look here at the diagrams that we looked at last month. And here there are three partners: the green partner, the red partner, and the blue partner. I've also added a spouse for each of them on the outside of the partnership, but you can ignore those. It's the three central circles that we're looking at, which represents the green partner, the blue partner, and the red partner. And then there's the overlapping central part, which falls within all three of their estates, and that is the joint estate, that is the partnership estate. Now, each of the partners is jointly and severally responsible for all of the debts of the partnership. So each of the partnership creditors are actually creditors of each of the partners individually. And that means that if the green partner is bankrupt as a standalone bankruptcy, then the bankruptcy debts will be their personal debts and also all of the partnership debts. And if the green partner, being bankrupt, also personally owns some of the partnership property, then that partnership property is outside the bankruptcy estate. And that's because they own the property on trust for others, being all of the partners in the partnership, including themselves. And that means that as trustee in bankruptcy of Green's personal bankruptcy, your only interest in the partnership assets is by claiming the net balance on their current account and their capital account, which may be a positive balance, in which case there's money that'll be coming into the bankruptcy, or it may be a negative balance, and the consequences of that will depend upon whether the other partners are solvent or not, and whether they're carrying on the business as a new partnership between themselves, and all sorts of other factors like that. Now, if the partnership itself is insolvent, and you also get yourself to be appointed as liquidator of the joint estate, in that case, you would wind up the joint estate separately, and you would pay the partnership debts from the partnership assets in the joint estate. And the order of priority is much as you would expect. Prefs come first, ordinary creditors come first, then interest on those unsecured creditors. Then there's a category of postponed debts, which is special for partnerships. Then there's interest on postponed debts. And if there is any surplus after that, that is then shared, returned to the partners. If it's an insolvent partnership, there won't be a surplus, there'll be a deficit, and that shortfall is then claimed from each of the partners' estates. They're jointly and severally, so the same shortfall is claimed from each of the partners. And in terms of the subclasses, there are, of course, two classes of preferential creditor. Technically, there are three classes of ordinary creditor. There's ordinary creditors, secondary ordinary creditors, and tertiary ordinary creditors. But secondary and tertiary ordinary creditors are very, very rare and unusual. You hardly ever see them. And the deferred creditors are certain types of partnership loans which fall within the definition of Section 3 of the Partnership Act. You're unlikely to see them, but if you do, they will be postponed and they will be paid within the liquidation of the partnership only after the other creditors have been paid. Now, looking at it from the point of view of the green partner's bankrupt estate, you have to pay their personal debts from their personal assets, and it's the normal order of priority. And also within that will be the shortfall claimed by the liquidator of the partnership. Will also be claiming as a creditor of the personal estate as well. And if there's any surplus left over after that, the bankrupt gets to keep it. If there's a shortfall, normal bankruptcy rules apply, and the bankrupt is released on discharge of the bankruptcy order. Postponed debts in the individual estate are different from postponed debts in the joint estate, and they're the normal postponed debts, which will include claims by the spouse and so on. So that's a quick canter through how we go about unscrambling the various estates in an insolvent partnership. Let's now look at a couple of case studies. The first one is the one that I'm calling the zombie partnership. And here the example are two brothers, Albert and Ben Zombie, and they've got an old-fashioned metal bashing business under the railway arches called fly-by-night engineering, of course. And HMRC have finally caught up with them and have presented petitions. There are three petitions running against them, two against the two partners for individual bankruptcy, and the third petition is to wind up the partnership, to make a compulsory liquidation order against it. And let's have a look at the chronology of this, because this is where it does get a little bit complicated. So here, all three petitions were presented on the 1st of June, but skipping down the chronology, you'll see that at the end of July, a winding up order was made on the winding up petition. And of course, a winding up petition is retrospective in effect. The liquidation is backdated to the date that the petition is presented. It's treated as starting then. So the partnership goes into liquidation. You only know this with hindsight, but the partnership actually went into liquidation on the 1st of June, the date that the winding up petition was presented against it. And the consequence of the partnership being in liquidation is that it is dissolved. That happens automatically. And as a result of the partnership having been dissolved, the partner's authority ends. They're no longer able to trade in that partnership. The only powers that they have got is the power to wind up the partnership. And of course, they haven't got that power either, because effectively the liquidation has already started. Despite all of that, the partners, of course, come back under the railway arches the following day, and they open up for business again, carry on bashing metal. And they carry on doing that throughout June, through July, when the first bankruptcy order is made against Albert. So he is now bankrupt. There's some issue with the petition against Ben. That gets adjourned, but Ben is declared bankrupt a month later at the beginning of September. And let's try not to suspend disbelief too much here, but let's imagine that you are now appointed trustee of both bankrupt estates and liquidator of the partnership by the Secretary of State. And let's have a look at what has actually happened here. We've actually got a series of partnerships. So the first partnership was the one that has been running since time immemorial and was dissolved at the start of the liquidation on the 1st of June. So that is Partnership 1 that came to an end on the 1st of June. Partnership 2 started the next day, and that one then came to an end when it was dissolved on the first of the partners, Albert, being declared bankrupt. That will automatically have dissolved that partnership. They both came into work the next day, so that then started partnership number 3. And that traded for a month and a day, and partnership 3 was then dissolved when Ben was declared bankrupt on the 1st of September. And of course, they came into work the next day. So we've had a 4th partnership that started from the 2nd of September and is probably still continuing. So it's not just one partnership that we're looking at here, but it's actually 4 successive partnerships that need to be unscrambled. And your analysis of this in your capacity as liquidator of the partnership and trustee of both of the bankrupt estates of the partners is this. You're the liquidator of the first partnership, and that still owns all of the assets. The assets, at least the tangible assets, have not been transferred to any of the successive partnerships. So you've got all of that hardware available to sell as liquidator of the first partnership. You're trustee of Albert's bankrupt estate, and that means that you're going to have to see final accounts for the first partnership and the second partnership to work out what claim or what is due to you from both of those partnerships, or indeed if either of them have got a claim in the bankruptcy. You're also trustee of Ben's bankrupt estate, and that will include needing to look at final accounts for the first 3 partnerships. And in all of this, you've actually got no authority over the assets in partnerships 2, 3, or 4. Now, fortunately, they're going to be pretty minimal, because all they will be is just the work in progress that they've got in those partnerships, the work that they've finished, the debtors, and any cash, although of course there won't be any cash. So that's an example of one of the problems that you can have in terms of winding up a partnership. First blush, it can look very simple, but when you actually take the covers off, it can be rather more complicated. Let's have a look at another one now, which I'm calling the untouchable partnership. And this is a cafe with 2 partners, Yvonne and Zeke Untouchable, trading as the Untouchable Cafe. And what they've got in this business is leasehold premises, the usual fixtures and fittings, a small amount of stock of negligible value, and unusually they've got a contract catering business as well that they run from the kitchen there. And family assets, between them they've got £150,000 of equity in the family home. They're facing bankruptcy petitions from HMRC, but not a winding up petition. And I'll give you the chronology of this here. So imagine that the bankruptcy petitions are presented at the end of October, and a few weeks later, they find somebody making a sensible offer to buy the cafe from them, let's say £25,000. But they run out of time because 2 weeks later, the bankruptcy orders are made against both of them, and that then dissolves the partnership. It comes to an end. And with the ending of the partnership, their authority to deal with the partnership assets comes to an end. They don't even have authority to wind up the partnership because they're bankrupt, so that authority has been taken away from them. And then after Christmas, the Secretary of State appoints you as trustee of both bankrupt estates. And you find out what's been going on, and you find out that in particular, the cafe is still open for business because they've got the keys. All they need to buy is a small amount of stock, and the customers keep coming in, and that's their income. So in terms of how you realise the assets in bankruptcies, first of all, of course, legal title to the family home does not vest in you because it's in joint names. That means that technically the family home is held on trust. So even though the trustees hold on trust for themselves as beneficiaries, it's still outside the bankruptcy, and you'd need either Yvonne and Zeke to sell the family home themselves and have their solicitor pay the proceeds of sale to you, or you might need to get a court order to sell it. Similarly, you have no authority to deal with the partnership assets, which are held by Yvonne and Zeke on trust for the partnership, which has now dissolved. So it's on trust for the dissolved partnership. Your only interest in the partnership is to claim any surplus that is due to either or both estates when the partnership is wound up. But you don't actually have authority to wind up the partnership yourself, and the partners don't have authority to wind up the partnership. So how do you deal with this? You've got a buyer who wants to buy the cafe, and they're not going to hang around much longer, so you need to sell it somehow. These are the options, I think, that you would be looking at. Firstly, you could petition for a winding up order against the partnership and get yourself appointed as liquidator, but that's going to take a little while, may take too long. Is also a fair amount of additional cost. Second option would be to speed things up to seek the appointment of a provisional liquidator with a winding up petition, which would allow the cafe to be sold quickly, but would add a great deal of additional cost, maybe disproportionate given the value of the assets here. Third option would be tempting, which would be just to take a view and sell anyway, but you may have problems there with the buyer solicitor not accepting, quite rightly, that you've got title to sell the lease. And I don't quite know how you would account for the proceeds of sale anyway, because without authority to deal with the proceeds of sale, remember that your claim is only for the net balance on the account of the partnership. You've got no authority to deal with the assets themselves. So without authority to deal with them, I think you'd have difficulty in actually taking the expenses of dealing with them from the proceeds of sale. Fourth option, which is probably the textbook option here, would be to apply to court to extend your powers so that you have the power as a trustee in bankruptcy of both of the partners' estates to wind up the joint estate in bankruptcy as well. So this would be effectively the court appointing you as trustee of a third estate, and your title there would be as trustee of the bankrupt joint estate of Yvonne and Zeke Untouchable Trading as the Untouchable Cafe. And so that would be the textbook approach to dealing with this. You could also perhaps see whether administration might be possible, see whether the purpose of administration could be achieved by appointing an administrator. That, of course, would be quick and relatively inexpensive. The final option is if the bankrupts are cooperative in this, they might be willing to sell the cafe themselves, with you joining in to receive the proceeds. But you've got the same problem there of how do you account for the proceeds of sale, given that you've got no authority to deduct any expenses from the proceeds of sale, because you've got no authority over the assets in the bankruptcy themselves. Now, I guess if the bankrupts can delegate all of that to solicitors who would deal with the expenses of the sale and account to you for a net proceed, but that's quite a lot of work for a solicitor to do, to be effectively drawing up final accounts in an insolvent partnership. So you may find that there's quite a problem there in dealing with all of that. Final thing I want to cover, last couple of minutes or so, is just to look at partnership administrations and what the issues are here. As I said, you can have the same sort of informal appointments as with companies. You can make the appointment just by filing the documents in court. It can be quite hard to find the forms, but it can be a relatively quick and straightforward way of getting an appointment. Couple of points. There are no qualifying floating charges in partnerships, but you do have to watch out for agricultural floating charges, which are treated as analogous to qualifying floating charges. And the moratorium may not be watertight, which is something I do want to talk about. I did ask Microsoft's image generator to find a diagram for me that illustrates an agricultural floating charge. And it came up with this. I have no idea quite what that is. It's very colourful and it's quite memorable, but how it represents an agricultural floating charge, I do not know. But move swiftly on from there. The moratorium that is set up by an administration, it works just fine in a corporate administration because of the legal personality the company has got. It doesn't work so well in a partnership because it's not always clear what are personal liabilities and what are partnership liabilities, because of course partnership liabilities are personal liabilities anyway. So there's a list here of what the moratorium is supposed to block. I'm just going to look at the penultimate one there, which is legal proceedings, and just as an example, give you some idea of what the potential problems are. The administration moratorium is supposed to block legal proceedings against the partnership, but the partnership is not a legal entity. It's the relationship between the partners. If the partnership is not in administration, if you have a creditor wanting to take debt recovery action through the courts, they could sue the partners in the name of the firm. So they could sue Untouchable Cafe, brackets a firm. They could sue the partners trading as the firm name. So there they'd be suing Yvonne and Zeke Untouchable trading as Untouchable Cafe. Or they could sue the two partners as individuals. So they could name Yvonne Untouchable and Zeke Untouchable on the claim form that the court issues. Or they could sue just one of the partners. Now, I think that the way that the administration moratorium is supposed to work is that it's supposed to protect the partners from partnership creditors, but perhaps not from personal creditors. And it's not always seeing whether a creditor is a personal creditor or a partnership creditor. I've got a couple of lists here, which is where I think I'd draw the line. But of course, if a creditor issues county court or high court proceedings despite the administration, you've still got to deal with those proceedings, and you've then got the expense and complexity of having to try and argue it. So those are the points I wanted to cover today. That's the end of this morning's session. So moving on from here, if you've got any questions, please ask them now if you'd like to do so, or email me afterwards if you'd like to do so. And I've got some dates for the diary here. A couple I'm just going to mention in particular. Thursday next week, the 20th of February, we've got the R3 regional meeting at the Empress of Blandings, Copythorne, just outside Southampton, very close to the motorway junctions. If you haven't booked yet, then please do so, because we haven't got an awful lot of time. And if you'd like to stay for dinner afterwards, and I do hope that many people will, you really need to book right now, because we have to give final numbers to the pub very, very soon. So please get on and do that. The other date I do want to mention to you is we have the date for our annual insolvency conference now. It is Friday the 13th of June. We've got a lovely venue for it. It's the Bewley Inn, which is in the middle of the New Forest. There are only 3 things where the Bewley Inn is, or 4 things. First thing is the pub hotel itself. Second thing is a railway station where occasionally trains do stop, but not very often. Third thing is over the road are the venue for the pony auction sales. I'm not expecting there to be one on the day that we're there, in which case it would be very busy. And the fourth thing is lots and lots of forest in every direction. There's absolutely nothing else there, so it's a lovely spot. And please stick the date in your diary now, and I hope to see many of you there. And with that, I will say thank you all very much. I hope you found this useful. There are 28 days in February, so it will be the 10th of March is the next coffee break briefing. And I think I'm probably going to be talking about disclaimer at that, which is a useful tool for insolvency practitioners. So once again, thank you all very much. Goodbye, and I hope to see you very soon. Cheerio.